Stock markets are at record highs. Corporate bonds look healthy, everything seems fine. But today, Europe's most powerful financial institution quietly published a warning that should make every investor stop and pay attention. And honestly, most American media barely covered it. The European Central Bank, the ECB, is essentially Europe's version of the Federal Reserve. It sets interest rates for 20 countries, oversees the continent's largest banks, and publishes a financial stability report twice a year. When the ECB speaks on market risk, serious people listen. Today, they publish that report, and what's inside it is not reassuring. The ECB's core warning is this: financial markets are underestimating the risks in front of them significantly. The report points to three specific dangers converging at the same time. First, the war in the Middle East. The ECB describes it as a major geo-economic shock that is actively disrupting global energy supply. That disruption pushes inflation higher while simultaneously dragging economic growth lower. A slowing economy with rising prices is the environment that historically causes the most financial damage, because central banks can't cut rates to stimulate growth without making inflation worse. Second, stretched valuations. Despite everything happening in the world right now, stock prices remain elevated by historical standards and corporate bond risk premiums, essentially what investors charge companies to borrow money, remain unusually compressed. In plain English, markets are priced as though very little can go wrong. The ECB's concern is that when something does go wrong, the correction won't be gradual, it will be sudden. Third, fiscal pressure on heavily indebted European countries. Several euro area nations are already carrying significant debt loads. If they increase spending to manage the economic fallout from the Middle East conflict, borrowing costs rise, confidence falls, and the risk of a sovereign debt repricing, where bond markets suddenly demand much higher rates, increases sharply. ECB Vice President Luis de Guindos put it plainly to CNBC today. There is, in his words, an elevated risk of a market correction, because valuations are high and geopolitical risk is the central concern. So, why should an American watching this care about a European banking report? 3 reasons. 1, your retirement account doesn't care where a correction starts. A sudden repricing in European sovereign debt markets or a sharp equity sell-off in Frankfurt reaches Wall Street within hours. Global markets are connected in ways that make geography irrelevant when sentiment shifts. 2, the energy supply disruption the ECB is warning about directly affects what Americans pay for petrol, heating, and goods transported by fuel-dependent supply chains. Higher energy costs in Europe flow into the prices of goods that cross the Atlantic. 3, the ECB is making a specific claim that American financial media tends to underreport, that markets are not accurately pricing the risks that exist right now. If they're right, the current record highs in US equity markets may be resting on a foundation that's less solid than the headlines suggest. This isn't a prediction of a crash. It's a warning from one of the world's most credible financial institutions that the gap between how markets are priced and how risky the environment actually is has rarely been wider. The full ECB Financial Stability Review, published today, is linked below. It's dense reading, but if you want to understand what Europe's central bankers are actually worried about, it's worth your time. That's The Insight. We find the journalism worth reading and make it accessible. Links always in the description. Give us a follow.